When to accelerate your mortgage payment or when not to. Episode 17. Welcome back to Retirement Solutions for All Ages. I'm your host, Ruth, the retirement mortgage expert at Nexa Mortgage. In this series, we've talked a lot about the power of home ownership as a wealth building tool, and in episode 3, we even challenged the traditional 30-year mortgage myth. But today, we're going to dive deeper into that very topic and explore some popular strategies for paying down your mortgage faster. You might be thinking, Ruth, I thought you said paying off your mortgage wasn't always the goal. And you're right. It's not a one-size-fits-all answer. So today, we'll not only discuss how to pay down your mortgage faster, but crucially, when and why you might want to, or when it might be better to let your money work for you elsewhere. We'll also break down the differences between fixed rate and adjustable rate mortgages and how that impacts your strategy. Let's get started on becoming mortgage masters. Let's assume for a moment that your goal is to pay off your mortgage sooner. How do you actually do it? There are 3 common strategies. 1, biweekly payments. Instead of making one monthly payment, you make a payment every 2 weeks. Since there are 52 weeks in a year, this results in 26 biweekly payments, which equivalents to 13 full monthly payments per year. This extra payment each year can significantly shave off years on your mortgage term and save you thousands in interest. It's a subtle but powerful change that many lenders offer, but not all. Make sure your lender applies that early payment immediately towards your payment instead of holding it in limbo until the monthly payment is due. This will pay down your principal faster. 2, adding a little extra each month. This is straightforward. Simply round up your payment or add a small fixed amount to your principal each month. Even an extra $50 or $100 can make a difference over time, especially if you've refinanced to pay off credit cards. Put what you were putting on that credit card towards your mortgage payment. Make sure to specify to your lender that this extra amount should be applied directly to the principal balance, not towards future interest. 3, making an extra lump sum payment annually. This can be from a tax refund, a bonus, or simply reallocating some savings. Applying a single larger payment directly to your principal once a year can have a substantial impact on reducing your loan term and total interest paid. These methods essentially do the same thing. They put more money towards your principal, allowing you to pay off the loan faster and reduce the total interest you owe. When do you want to pay down your mortgage faster? While I often advocate for leveraging your home's equity, there are absolutely valid and smart reasons to prioritize paying down your mortgage. 1, peace of mind. For many, the emotional security of being mortgage-free is invaluable. The feeling of truly owning your home free and clear can provide immense psychological comfort, especially as you approach or enter retirement. This goes back to the American dream mindset that we discussed in episode 3, where owning a home outright was the ultimate goal. 2, reducing fixed expenses in retirement. Eliminating a significant monthly payment can drastically reduce fixed expenses, freeing up cash flow for other needs, travel, or simply living comfortably on a fixed income. This can be particularly appealing if you anticipate a tight budget in retirement. 3. Approaching retirement with debt aversion. If the idea of carrying debt into retirement causes you stress, aggressively paying down your mortgage can be a smart move to align your finances with your comfort level. 4. High interest rates. If you have a mortgage with a particularly high interest rate, paying it down faster means that you're reducing the amount of high interest debt, which can be a very efficient use of your money. But don't be paying down your mortgage if your credit card bills are higher than that interest rate. When you don't want to pay down your mortgage faster. Now, here's the flip side. Just as there are good reasons to accelerate your payments, there are equally valid reasons not to, especially when there might be better uses for your money. 1. Low interest rate versus investment returns. As we discussed in episode 1, the magic of compounding can lead to significant returns in diversified investments. If your mortgage interest rate is, say, a low 2 to 4%, and you can reasonably expect a higher risk-adjusted return from investing that extra cash, historically, the stock market averages around 10%, then your money might be working harder for you in investments rather than being tied up in your home's equity. Every dollar you give the bank is a dollar that you didn't invest. 2. Lack of liquidity. Once money is paid into your home's equity, it's not easily accessible without taking another loan, like a HELOC or a reverse mortgage. If you tie up too much of your cash in your home, you might be house rich and cash poor, leaving you vulnerable to unexpected expenses or emergencies. We saw the dangers of this on Grandma's on the Ruth episode. 3. Higher interest debt. If you have credit card debt, personal loans, or other debt with much higher interest rates than your mortgage, it almost always makes more financial sense to pay down those high interest debts first. 4. Other financial goals. Perhaps you're saving for your child's education, a down payment on a rental property, like the Burr method in episode 7, or building an emergency fund. These other goals might offer a greater return on investment or more immediate financial security than accelerating your mortgage payoff. Fixed rate versus adjustable rate mortgages. Your mortgage type also plays a big role in this decision. Fixed rate mortgages. With a fixed rate mortgage, your interest rate and monthly principal and interest payments remain the same for the entire life of the loan, whether it be 15 years or 30 years or some number in between. This provides predictability and stability, which many homeowners appreciate. If you have a very low fixed rate, especially one obtained years ago, accelerating payments might not be the most financially optimal strategy if you can get higher returns elsewhere. However, if that peace of mind is paramount, go for it. Adjustable rate mortgages. An ARM, adjustable rate mortgage, is an interest rate that can change periodically based on an index. They often start with a lower introductory rate for a set period, 5 or 7 years, and then adjust. If you have an ARM and your introductory period is ending, or you anticipate interest rates rising significantly, paying down your principal faster can reduce the impact of future rate increases on your monthly payment. For many, the uncertainty of the ARM's future payments makes paying it down faster a very attractive option. Ultimately, this decision to pay down your mortgage faster is a personal one, weighing your financial goals, risk tolerance, and current interest rates against alternative uses of your money. With an ARM, however, most people do refinance within 5 to 7 years, naturally, not just because they have an ARM. Understanding these strategies and considerations is key to making informed decisions about your largest asset. Whether you choose to pay off your mortgage aggressively, leverage your equity for investments, or find a balance that suits your lifestyle, the goal is always the same: to build security and a fulfilling financial future. If you're exploring these options or simply want to understand how your mortgage fits into your overall retirement plan, let's connect. You can reach me directly by phone at 828-888-LOAN. That's 828-888-LOAN. Or you can email me at ruth@nexamortgage.com. Thanks for joining me on Retirement Solutions for All Ages. If this episode sparked new insight for you, please leave us a review, share it with a friend who might benefit from these strategies, and hit that subscribe button so you don't miss future insights. Until next time, I'm Ruth, the retirement mortgage expert, helping you master your mortgage for every age.